Our third and final income approach valuation method is the discounted cash flow or DCF method. And hopefully you are fairly familiar with this method from some of your other financial classes. But the DCF method is based on a principle that you as an investor are not going to be willing to pay any more for what the cash flows, the discounted present value of the cash flows that this property or asset produces. So to value a property, we're going to use the unlevered pre-tax cash flows, which is basically going to be the cash flows irrespective of what the actual financing structure or your individual tax situation are. So this is going to provide a value based solely on the performance of the actual property. So that comes up with the property value. If we want to then determine what the equity value is, we would determine first and start with the property value, and then we would subtract out any sort of liabilities or debt that we had. So to do this, the first step is we need to determine what our hold period is. Once we've determined our hold period, then we are going to pro forma or forecast unlevered pre-tax cash flows for that time period, plus the NOI for one period past our hold period. So if our hold period was for 5 years, we would come up or calculate pro forma unlevered pre-tax cash flows for those 5 years, and then we would go one period further and project or pro forma what the NOI is for that 6th period. We want to make sure that we use any rents or leases that are already in place and makes assumptions based on market preferences in order to complete our unlevered pre-tax cash flow stream. But we've got to remember to use what we consider either normalized or recurring reserves for TIs, LCs, and CapEx, because we absolutely want to make sure that we include those in our cash flows, because that will be cash that the next owner has to pay for. So we want to reflect that in our sort of clean cash flows. Once we have pro forma'd our different cash flows, we then want to select a discount rate for these cash flows. And we need to remember, just like with all of our financial theory, this discount rate has got to reflect the market risk for investments, similar type investments with the same risk. Lastly, we need to select what's called an exit cap rate or a going out cap rate. And this is in order to calculate the property's terminal value. So oftentimes investors are going to use the going in cap rate or the cap rate they use to purchase a property in period 0, and they're going to add, to be conservative, either 50 or 100 basis points to the going in cap rate. Additionally, it's not necessary that you do this, but to be conservative, you can do this, or you might go through and take a look at historic cap rates, see where the highest cap rate was sort of in a very stressful time period. You could use that, or you could go out to third-party sources that report what cap rates are. Let's take a look at an example here. So let's make a couple of assumptions. Let's assume that our hold period is about 5 years. We have a discount rate of about 7.5%. Our going in cap rate is 5%. So when we purchase it in period 0, we use a cap rate of 5%. And we are going to assume a going out cap rate of 6%, which, because we couldn't find any information, we took our going in cap rate of 5%, added 100 basis points or 1% for a total of 6%. So our next step is basically to pro forma the unlevered pre-tax cash flows and NOI. So we can see we start with PGI, we subtract out vacancy and collection loss, that gets us our EGI. From that we subtract out op expense, and any recurring capital expenditures. In this example here, we don't have any, but if you did, this is where you'd put them. And when you take the sum of all that, you get your NOI. So we have projected NOI for 6 periods. We additionally need to pro forma and some numbers for TIs, LCs, and non-recurring CapEx so we can get the unlevered pre-tax cash flow for the first 5 periods. And that's what we've done. You can see in period 2 we have TIs and LCs, and we have a non-recurring CapEx item in period 5. We make those subtractions from the NOI, and that leaves us with our unlevered pre-tax cash flows for periods 1 through 5, and an NOI that we will use on the next slide to calculate the terminal value. Then we need NOI from period 6. All right, so let's use the information that we created on the last slide to come up with our value for this property. And what we need to do in the essence is to discount these cash flows. So on this slide, you can see that the information we had from the last slide is here. So we have an unlevered pre-tax cash flow for period 1 at $52,250, and we project it all the way out to period 5. Now we need to add a couple of things. The first thing we need to add is the terminal value. And the terminal value is the value that you basically are going to assume that you sell the property for. So if we have a 5-year hold period, we need to assume that we sell the property at theoretically the last day of period 5. We need to know what that amount is. And so to do that, we put ourselves in the shoes of the next person who's going to own the property, so the person who will buy it from us at the end of year 5, and we assume that they use a direct capitalization valuation method. And for that, they need to know the next period's NOI. And in our case, this is $60,572. And they need a cap rate. And that's where we use the exit cap rate. And so in our assumption, what we calculated on the last slide is we use 6%. So basically, we take the $60,572 of NOI for period 6, divide it by 6%, and we get a little over $1 million. And again, that comes to us in period 5. So now we have all the cash flows, or you can see a line here called total cash flows. This basically just sums the operational cash flows, which we calculated on the last slide, and we add to that the terminal value cash flow, which we experience in period 5. So that is the cash flow stream that we're going to discount. So I have a line here. I sort of do it the old-fashioned way because I want to show you guys how the math works and all the different steps. But I calculate what a discount rate is. And to do that, you can see for the first period, the discount rate's 1.075. The way I got that is I added 1 plus the discount rate. So the discount rate we're assuming is 7.5%. So 1 plus 7.5%, and then I take that sum to the power of whatever period it is. So to get the 1.075 discount rate in period 1, I take 1 plus 7.5% and then take it to the first power. For the second period's discount rate, I take 1 plus 7.5% and I take that to the second power because we're in the second period. And I do that for all 5 periods. Once I've done that, to get the actual present value, all I need to do is take the cash flow, the total cash flow that I've calculated, and divide it by the discount rate. And so you can see that on the line on the slide here. That's called present value of cash flows. And to get the total net present value, or what I think the property is worth, you just add up all of those present values for the cash flows. And in our case, we get a property value of $879,444.
Another way to use the cash flows is to calculate your internal rate of return, or IRR. You want to make sure that the cash flows that you use to calculate your IRR are non-discounted cash flows. Once you've calculated your IRR, you want to compare it to your target rate. If your IRR is greater than your target rate, then you should proceed with the project, and in our case, this is to purchase a building. However, if your IRR is less than your target, then you want to walk away. So you can see on this slide, we start with period 0, which is where we make the down payment for the property. We own it for 5 years, and it generates 5 years of operating periodic cash flows. And in the last period, we have the sale price, the residual or terminal value that comes in. We calculate the IRR by hitting equals IRR, left parentheses, and then we highlight the cash flow stream that we want to calculate this for, right bracket, and then hit enter.
While the DCF method is one of the most preferred methods of coming up with value for commercial real estate, and there are a lot of benefits to it, there are some limitations which I'd like to go over right now. So many assumptions have got to be made, and that means it's easy to justify a high price. And if you come into a negotiation or come into valuing a property and have a price already sort of anchored in your mind, it's easy to change the assumptions a little bit and come up with a price that justifies where you originally thought the price should be. You've got to answer what's the appropriate discount rate, what's the appropriate exit cap rate, and what's the appropriate growth rate for either rents and or expenses. And so any tax benefits that you're going to assume, they might not last. So one way that people try to mitigate some of these limitations is that they use a Monte Carlo method to perform a valuation. And they use they select a couple of key assumptions. So a couple of key assumptions might be the discount rate or the exit cap rate or maybe even the growth rate. And they perform a Monte Carlo method to see what the value range comes out when you use a distribution for some of those key variables. So a few caveats in using this method. Don't forget about risk. It's so easy to project unlimited profit, but that's really not realistic. You also have to be careful with debt. Financially speaking, usually if you don't model it correctly, the more debt you add, the higher your returns. But you've got to remember that if cap rates exceed mortgage rates, higher leverage is always going to win. And profits can increase exponentially, but remember with high leverage, one bad property can bring down an entire real estate empire. So the very last thing you need to do when you're valuing a property is you need to reconcile the different methods. So you might have a value from your cost methodology, you might have a value from your sales comparable methodology, and you might have a couple of different income values from your 3 different income methodologies. You need to bring those all together and to come up with one value. So you should try to perform at least both the sales comparables and the DCF method. And to reconcile the differences between the two, you can take an average of all of your value indications, or you can give a different weight to each of the different sales. So maybe you feel more comfortable. You like the sales comparison approach and the DCF approach as well. So you can give it, but you feel that the DCF more suits your situation, so maybe you give that value a 75% weighting and the sales comparable just a 25% weighting. Usually one method is going to be more applicable to your specific situation, and you can just use that method. Like I said earlier, a lot of times when I was valuing a building that was already constructed, I didn't even use the cost methodology. I would rely on the sales comparable method and the DCF method. But you need to reconcile and come with one value. All right, let's wrap this topic up with a couple questions that you might see on a quiz or an exam.